Guys, I'm going to share with you the reality of a stock market crash and the potential of one coming up. And if there is one, what am I going to do in response to the stock market crash? Guys, there's a lot of YouTube finance people out there putting a lot of scary videos out there, declaring a certain date for a crash, what you should do, should you go to cash? They're all out there. I want you to hear me very quickly. They have no idea what they're talking about. You cannot possibly guess the date of a stock market crash consistently. If somebody gets it right, it's 1,000,000% pure luck. Do not listen to them. Now, are things expensive? Is there a higher likelihood of a crash today than there was 10 years ago? Absolutely. Let me get in those numbers right now. This is our stock market to GDP ratio. This is the longest running ratio that Warren Buffett says is the single most reliable metric on where valuations stand at any given time. I've pulled it back on the S&P going back to 1929. As of this very second, it shows 95.9% overvalued. If you look at this chart right here, this is it going back to 1929 and where we are today, all right? Only a little bit of time there when 1929 was worse. And when was it best? Lowest in 1982. Guys, it's no coincidence that the lower this value, the better future returns are. Let me show you. Going back to 1982 was the all-time low of this metric. We were 65% undervalued right here in June of 1982. The next 10-year returns without dividends was 14.3%. 14.3% without dividends. And it makes sense. The lower you pay, the more you earn. Now, let's go to the dot-com crash. Let's go to 2000, when the market hit a peak of 55.3% overvalued in March of 2000. The next 10 years, minus 2%. And again, it makes sense. The scary part is we are 95% overvalued today versus 55%. So you're probably sitting there thinking, well, Paul, I should sell. Hang on a second. Not so fast. And here's why. We have been overvalued at a level higher than every other time in history except for the Great Depression and the dot-com boom since March of 2017. This is a level of overvaluation at 30% or more overvalued, and it keeps on going. The S&P back then was 2,300, and now it's 5,100. And keep in mind, back here, I thought fair value in the S&P was around 1,300 to 1,500. Today, I think fair value in the S&P is about 2,600. So, as time has gone on and GDP has gone up, fair value should increase. Now, for those out there who say, Paul, stock market GDP is so past its day, it doesn't make sense, you're wrong. You're absolutely wrong. Yes. Is there more money made overseas today than there was 100 years ago? Sure. But let's pull up another metric. The 10-year cyclically adjusted PE ratio. What this does is it takes the earnings of the S&P, no matter where the money is earned, Timbuktu or Tennessee, it doesn't matter. Wherever it's earned, it's part of the earnings. And guys, we're at 34.44 times the 10-year earnings. Historical average is 17.1. We're over double. We're 101% overvalued. So both metrics, whether you look at earnings or total value, are overvalued. And these are the two most reliable metrics for future returns. Now, it seems kind of odd though. Markets keep going up. How is this possible? We're this overvalued. Well, that's just the way markets are. Markets can be irrational longer than you can stay solvent. That is why your job is not try to guess when things are going to happen. Don't enter into that game. I can pull out of stocks and be fine and sit in cash because I've got business upstairs, real estate upstairs. But the vast majority of people watching are people who need to save for retirement, month in and month out. So when I hear people talk about going to cash, I always urge against that. However, if you already have enough in retirement now and you want to put a little more on the sidelines, by all means. If you have a portion of your money that you set aside for individual stocks and you don't want to buy more individual stocks, but you're already on your path to retirement with the vast majority of your money in ETFs that you keep adding to every month, by all means, find your right deals and wait. But your main source, as long as you're sticking to your plan, should be dollar cost averaging into low cost ETFs. And let me show you why right now with this crazy stat. In the last 30 years, if you missed the top 10 days, that's it, the top 10 days of the market's returns, your returns were 50% lower than the market. 50% lower by missing the top 10 days. Your job is not to time things. Your job is stick to a plan. Let me show you. I've done this chart 1,000 times. This is the market over long periods of time. But this is how the prices go. Your job is to invest all along the way. So you're never guessing when you should be in and when you should be out. And over time, you'll average this. Yes, there'll be volatility. Volatility is your friend. Down markets are your friend. This is what I want you doing. Again, if you have a portion of your money set aside, 10%, 20% for individual stocks, I encourage you, pick a process that works for you and be cautious about it. Pick the right times to buy the right companies. But 80, 90% of your money that's set for retirement, stick with the plan that works. Don't try to guess what's going to happen. Because when you look at all of these, if you had done the same thing 8 years ago, 7 years ago, you'd have missed out on tons and tons of gains. Guys, it is a reality. The more you pay for something, the less your return will be. This iPhone is worth $1,000. Do you make more money if you pay $900 for it or $300 for it? If this is something that can't be understood, I don't know what to say. Now, it's exciting. The markets are going up. NVIDIA is going up. All these high-flying AIs changing the world. Guys, in the last 150 years, how much technology has changed the world? Cars changed the world. Airplanes changed the world. Radios changed the world. TVs changed the world. Computers changed the world. Internet changed the world. Real estate changed the world. EV changed the world. AI changed the world. And guess what? Look, apart from AI, the bubbles burst in all of those at some point. Even EV has had the bubble burst. We're looking at Tesla, a company that couldn't miss 3 years ago, is lower than it was 3 years ago, even though the business is much better today. So here's what I will do if the market crashes. I'm going to do the same thing I did in 08 and 09. I'm going to load up. And guess what? As I start to load up, what's going to happen in the market? It'll probably continue to go down. But that's not the point. The point is I'm buying at better prices. In fact, if you have the ability on this chart, when I sat there and did this, if you have the ability to put more money in at these points, I've done the back tests going back to 1929, and you can increase your returns by 2 to 3% per year overall by adding more money when values are below the historical average. Below. That's what's incredible. Now, is it easy to do? From this standpoint, of course it is. Markets are up. We can't imagine. Every single time markets are up, and I ask people, hey, if the market fell in half, what would you do? I'd buy more. And then guess what? When the market does fall in half, there's a story out there. And that story will tell you why it's different. No, Paul, but the difference is we didn't expect X, Y, and Z. It's always the case. And that's why your Uncle Paul here will be here to make you feel better if markets crash, which as time goes on and we stay at these high level valuations is an increased likelihood. Now, I have a great story of that back in 07 and 08. But before I get there, guys, if you want to get access to talking about this before it actually becomes news, join our community, everythingmoney.com, $7 for 7 days. You get all of our amazing tools, plus the community chat with thousands of people inside of it. So just go there, check it out. $7 for 7 days is our great promo. But back in 06 and 07, I had a good friend of mine. He had just gotten married. His wife sat me down and said, hey, we want to save for retirement. Can you help us out? I said, sure. First question I asked them, guys, if stocks fell by 50%, what would you do? And the wife looked at her husband, looked at me and said, we'd buy more, wouldn't we? And I tell this story all the time because it was my first time going, wait a second. So fast forward 2 years, markets are crashing. I'm buying a ton. And I have absolute proof that I was buying a ton. I get an email from the wife. Paul, what's going on here? This is so scary. I wrote back, if you remember, we talked about this. And I asked you, and you said you'd buy more. I'm buying more. She's like, you are? I said, yes. Don't you remember that conversation? I do, but I never expected this to happen. And I was like, oh my gosh. Fast forward a month. I was talking to her husband. I said, what did you guys do? We just sold everything. You know, we're going to go to a financial advisor because we felt too scared to be involved in just these ETFs and blah, blah, blah. And I was like, oh my gosh. We literally had this conversation. In order for the market to fall 50%, they have to attach a story to it. News follows the stock price, not the other way around. I don't care what there'll be some news that makes you go, no, it's different though. And that's the point. So guys, again, if you want to have a conversation about this, go to everythingmoney.com, sign up for 7 days for $7 free trial. Take care.